In the world of accounting, there exists a delicate dance between two fundamental concepts, debits and credits. It's a rhythm that governs the flow of money in and out of the business, ensuring that every transaction is meticulously recorded and balanced. Now, I know what you might be thinking. Debits and credits. That sounds boring. But hang on, because understanding these concepts is crucial to grasping how businesses operate, and it's not as dry as it sounds. Imagine for a moment that every financial transaction is like a conversation between two friends, each with their own perspective, yet both essential to the story. Let's start by breaking down what debits and credits actually are. In the simplest terms, a debit is an entry that increases the value of an asset or expense account, while a credit decreases it. Conversely, credits increase the value of liability, equity, revenue, and gain accounts while decreasing the value of assets, expenses, and losses. Think of it this way: if you were to receive money, that's a debit to your cash account because it's an increase in assets. But if you were to pay off a debt, that's a credit because you're reducing your liabilities. It's all about balance, and that's where the magic of double entry accounting comes into play. Every time a business makes a transaction, there's a corresponding entry on both sides of the ledger. This means that for every debit, there's a credit that matches it, keeping everything in harmony. Picture it like a seesaw. If one side goes up, the other must come down. If a company buys a new piece of equipment for $1,200, it debits the equipment account, increasing its assets. At the same time, it credits its cash account, decreasing its assets. The total debits equal the total credits, and the books remain balanced. This balance is not just a formality, it's the essence of financial accuracy and integrity. Now, you might wonder why this is important. Well, imagine trying to run a business without knowing if you're actually making money or losing it. With debits and credits, businesses can generate income statements, balance sheets, and other financial documents that provide insights into their financial health. These documents are essential for decision making, whether you're a business owner looking to expand or an investor trying to determine where to put your money. Let's delve a little deeper into how these entries affect various accounts. There are 7 types of accounts in the general ledger: assets, liabilities, equity, revenue, expenses, gains, and losses. Each of these plays a crucial role in depicting a company's financial situation. Assets are what the company owns, like cash, inventory, or property. Liabilities are what it owes, such as loans or accounts payable. Equity reflects the shareholders' interest in the company. Revenue is the money earned from business operations, while expenses are the costs incurred to generate that revenue. Gains and losses reflect changes in value from non-primary business activities. When a transaction occurs, it's not just about adding or subtracting money, it's about understanding how value is transferred between these accounts. Let's say you purchase office supplies on credit. You would debit the supplies expense account, increasing your expenses, and credit the accounts payable account, increasing your liabilities. This transaction tells a story: you're consuming resources now, but will pay for them later. It's a snapshot of your financial decision-making process. But here's where it gets interesting. The definitions of debits and credits can be a bit counterintuitive, especially if you're used to thinking in terms of banking. In everyday language, we often associate debit with money going out and credit with money coming in. However, in accounting, it's all about the context of the account. A debit increases an asset, but decreases a liability. This distinction is critical to grasping the double entry system. Now, let's talk about the importance of maintaining this balance. A company's financial health hinges on accurate record keeping. If debits and credits don't match, it's like a puzzle with missing pieces. You can't see the full picture, and that can lead to poor decision making. Imagine trying to figure out if your business is profitable when your books are out of whack. It would be like driving a car with a foggy windshield. You might get somewhere, but you won't have a clear view of the road ahead. To avoid this chaos, accountants and bookkeepers rely on accounting software to manage debits and credits efficiently. This technology automates many processes, ensuring that every transaction is recorded accurately. It's like having a trusty co-pilot on your financial journey, helping you navigate the complexities of accounting. With the right software, debits and credits are automatically posted to the appropriate accounts, reducing the risk of human error and streamlining the entire process. Let's take a moment to consider a practical example. Suppose you make a $500 credit purchase of supplies. You would debit the supplies expense account and credit the accounts payable account. This simple transaction provides a clear picture of your financial obligations. You know exactly how much you owe and how much cash you have on hand. It's transparency in action, and that's what every business needs to thrive. Now, as we explore these concepts, it's essential to address some common misconceptions about debits and credits. One prevalent myth is that debits always increase an account balance, and credits always decrease it. This is not universally true. Remember, it depends on the type of account. Debits increase asset and expense accounts but decrease liability and revenue accounts. It's all about context. Another misconception is that debits mean money coming in, while credits mean money going out. Instead, they represent changes in various accounts based on the rules of double entry accounting. When a company receives cash, it debits the cash account and credits the revenue account. It's not about the cash flow itself, but about the relationship between accounts. Then there's the idea that debits are good and credits are bad, or vice versa. This binary thinking can cloud your judgment. Debits and credits are neutral tools used to record transactions. Depending on the situation, either could be seen as beneficial or detrimental. A debit to an expense account might not be great for the bottom line, while a credit to a liability account can signify a positive reduction in debt. Lastly, some people believe that debits must always equal credits in every transaction. While it's true that the total debits must equal total credits for the books to balance, individual transactions can involve multiple debits and credits. It's a more complex web than it initially appears, and that's what makes accounting both challenging and fascinating. As we wrap up this exploration of debits and credits, remember that these concepts are the backbone of financial management. They provide a framework for understanding how money flows in and out of a business, helping to create a clear picture of its financial health. Whether you're a budding entrepreneur, an established business owner, or simply someone looking to better manage your personal finances, grasping the principles of debits and credits will empower you to make informed decisions. So, the next time you hear the terms debit and credit, don't roll your eyes or tune out. Embrace the knowledge they bring. They're not just accounting jargon, they're the keys to unlocking the mysteries of financial success. With a little practice and understanding, you'll find that debits and credits are not just numbers on a page. They're the story of your financial journey, a narrative that unfolds with every transaction you make. And that, my friends, is something worth paying attention to.